Today, we are still sitting on companies that are distributing a maximum amount of dividends, so they are generating a lot of capital, and are actually sitting on the highest capital buffers of pretty much ever since we actually started doing this. The last 6 months have been pretty eventful in markets, mainly on the back of the Trump administration and the campaign promises that the administration had actually won the election on. So it has become, from a macroeconomic perspective and also from a microeconomic perspective, very difficult to forecast things over the long term, where normally we'd have a little bit more clarity. Ultimately, in the US, everything is rotating around the large fiscal bill, and also it is quite difficult to understand the stance, net of tariffs, that the fiscal policy of the US will adopt going forward. In Europe, we have a slower growth environment, slightly more boring. But on the other hand, on the back of these titanic shifts internationally, for example, the German government has passed or has expressed the willingness to loosen their fiscal stance by 1 trillion, and this is very, very large. All of this is actually very positive for the companies or banks that we invest in. And the backdrop of the last 3 years with much higher inflation and rates have proven that the efforts to rebuild the financial sector in Europe have actually paid out. Today, we have a sector that is sitting on the highest level of profits pretty much ever, on the highest capital and capital buffers of pretty much ever, with very clean balance sheets. And so even a tightening environment like the one we have seen where rates in Europe went from negative 50 basis points to 4% have led to almost no deterioration in asset quality and very solid profits at the bank's level. So today, bank profits in Europe are 70% higher than they were in 2019. In some cases, for example, in Southern Europe, these are 2 to 3 times higher than they were in 2019. So this is a very strong development. On the other hand, and given we invest in credit, we care about buffers. Profits are the first line of defense for your investment. The second line of defense, so let's say we are wrong, is capital. And today we are still sitting on companies that are distributing a maximum amount of dividends, so they are generating a lot of capital, and are actually sitting on the highest capital buffers of pretty much ever since we actually started doing this. So today, when we look at financials and financial credit in particular, spreads remain attractive on an absolute basis, and we see select room of compression. We see some select compression going forward. When you look inside the index, there is a lot of dispersion. There are companies that are actually still trading wide, and so we can see there is potential for alpha generation. There is a note of caution in primary markets, where we have been much more selective over the last 12 months than what we had been before, because reset spreads for new perpetual bonds are pretty tight. And given we have a much better vintage of bonds in our portfolio, we don't feel the need to extend by 1 or 2 years and buy a much worse quality bond. We actually feel much better in the bonds we bought 2 and 3 years ago, which today are the core of our portfolio.